If you've ever looked at a stock price and thought, why is it constantly changing? You probably assume Wall Street big shots and fancy suits just set the price behind closed doors. But that's not how the world works in 2026. In this guide, we are diving deep into what really drives the market, starting with the mechanical how and ending with the fundamental why. At its core, the stock market is a massive, chaotic, high-speed marketplace. On one side, you have buyers. On the other, sellers. They are haggling over prices in real time. But today, they aren't just humans. They are high-frequency algorithms and AI agents capable of making thousands of decisions in a millisecond. To understand the how, we must look at the market's secret playbook, the order book. This is a live, constantly updating list showing what people, or bots, are willing to pay. On the left, you see the bids, a stack of green numbers representing buyers shouting, "I'll pay this much." On the right, the asks, red numbers where sellers say, "I'm not letting go for less than this." The middle ground, where a buyer and seller finally agree, is the current market price. But here is the kicker. The price you see on your app is just the ghost of the last transaction. It is not necessarily the price you will get if you click Buy right now. The real price is a living, breathing battle between those bids and asks. When excitement or hype hits, buyers get aggressive. They hit the ask, meaning they stop haggling and pay whatever the seller wants. This frenzy creates a vacuum that sucks the price upward. Conversely, when fear takes over, sellers hit the bid, dumping shares at whatever price buyers offer, causing the price to cascade downward. But why does a stock deserve a specific price? Why is one company worth $10 and another $1,000? This brings us to the concept of intrinsic value, the soul of a stock's price. Intrinsic value is an estimate of what a company is truly worth based on its fundamentals, earnings, assets, and growth potential. It's the fair price if you ignore all the noise, panic, and TikTok trends. However, calculating it in 2026 is different than it was a decade ago. It's no longer just about counting factories and inventory. It's about valuing intangibles, like proprietary AI models, data moats, and carbon credits. The most respected method for finding this value is the discounted cash flow, DCF. Think of it as a time machine for money. You project how much cash a company will generate over the next 5 to 10 years, then discount that money back to today's value. Why? Because $1 in 2030 is worth less than $1 today due to inflation and the opportunity cost of not having that money now. If a company is projected to make $1 billion over the next decade, and after discounting it, that value equates to $700 million today, you divide that by the number of shares. If the resulting intrinsic price is $50, but the market is selling it for $35, a value investor sees a margin of safety and buys the discount. Another popular tool is the dividend discount model, DDM. This is for the boring but beautiful companies, the utilities and consumer staples that pay you just for owning them. If a company pays a reliable $2 dividend, and that dividend grows by 4% every year, you can calculate the stock's value based on that income stream. It's like buying a rental property. You care less about the daily fluctuations of the house price and more about the monthly rent check. Then there is asset-based valuation, which is essentially the liquidation value. If you sold every building, every patent, and every server, then paid off every debt, what's left? In a world of tech giants, this method often provides a floor for the stock price, ensuring you aren't buying a hollow shell. Lastly, we have earnings multiples, like the P/E ratio. This is the quick and dirty way to compare stocks. If the average AI chip company trades at 30 times its earnings and your target company is trading at only 15 times, it might be undervalued. Or it might be a value trap where the market knows something you don't. In 2026, we also look at data-to-price ratios, measuring how much actionable consumer data a company controls relative to its market cap. However, if math was the only thing that mattered, every accountant would be a billionaire. The reality is that the market is often irrational. Take growth stocks or meme stocks as an example. For years, companies like Tesla or the latest AI startups have traded at prices that make traditional DCF models look ridiculous. Why? Because of market sentiment and future expectations. Investors aren't paying for what the company is today. They are paying for a dream of what it will become in 2030. They are betting on the network effect, the idea that as more people use a service, it becomes exponentially more valuable. When sentiment is high, the fear of missing out, FOMO, overrides the calculator. External factors also play a massive role. Interest rates are the gravity of the financial world. When central banks raise rates, the discount rate in our DCF model goes up, which automatically shrinks the value of future cash. This is why tech stocks often crash when inflation stays high. It's not that the companies got worse. It's just that their future money became less valuable in today's terms. Furthermore, in 2026, we must consider geopolitical risk premiums. A sudden trade restriction on semiconductors can shave 20% off a stock's intrinsic value overnight, regardless of how many iPhones they sold last quarter. So, is intrinsic value still useful? Absolutely, but with a caveat. For a value investor like Warren Buffett, it is the North Star. Buffett famously said that investing is like buying a farm. You look at the soil, the climate, and the crop yields, not whether your neighbor thinks the farm is worth more today than it was yesterday. It provides a psychological anchor. When the market is panicking and prices are falling, knowing the intrinsic value of your holdings allows you to stay calm. You realize that while the price is down, the value of the business hasn't changed. But for growth investors, intrinsic value is a moving target. In the fast-paced 2026 economy, a company can pivot its entire business model using a new AI breakthrough in 6 months. This makes long-term forecasting incredibly difficult. In these cases, the market price is often a reflection of the collective intelligence, or collective madness, of millions of participants trying to price in a future that hasn't been written yet. To wrap this up, remember that the stock price is a conversation. The how is the mechanical interaction of bids and asks in the digital order book, driven by lightning-fast algorithms. The why is the constant struggle to estimate a company's true worth through models like DCF, P/E ratios, and asset analysis. Successful investors understand both. They use the why to pick the right companies, and the how to understand the best time to enter or exit a position. Before you go, a quick reminder. The stock market is a high-risk environment. Intrinsic value is an estimate, a best guess based on available data. It is not a guarantee. Markets can remain irrational longer than you can remain solvent. Always perform your own due diligence. Stay updated on 2026 economic shifts, and never invest money you cannot afford to lose. This is not financial advice, but a roadmap to help you navigate the complex, thrilling world of finance. If you found this breakdown helpful, hit the like button and subscribe to Martech Finance. We are building a community of smart, informed investors who look past the ticker symbols to see the real world underneath. Thanks for watching, and I'll see you in the next one.